So to answer the question, we need to zoom out a bit. So first we go to the monthly, and I marked the high, midpoint, and the low point of January with blue lines. So top, mid, bottom. And on the 3 month, on the quarterly, same thing. Top is red, middle is red, bottom is red. So when we go back to the daily, we see that we're at the midpoint on compared to the January candle. And when we go even lower, we can see that we finally broke below the midpoint from January, and we backtested it once, didn't make a new low. We tried to backtest it again and still getting rejected. If this gets rejected and tries to move down now, it'll probably go below 4900. But if it goes up, it will go, it will break the downtrend and it will have a bounce. And most likely it will go up to 4000, and this is the short point. So how I think it will play out in a bearish mode is like this. So this was the January levels, and the quarterly levels. We see that the 50% level is where the December bottom was. So we overshot a bit, but in general it held. And now we have a combo of both January and the quarterly midpoint, the January low and the quarterly midpoint being at the same level. And if we break the quarterly midpoint, we have a chance of doing an engulfing candle because we took out the highs of the quarter, of the previous quarter. Now we started to go down. If we break below the midpoint, there's a potential for an engulfing candle 50% rule. But first of all, let's see if this is possible. Like how low can we go and what's the time frame? No, how fast do we need to go down? So comparing to the current level, and the target end date is the end of the quarter. So any move that starts now potentially will continue until the end of the quarter. And we need to go around 11.5% down. Is this even plausible? Well, let's see. Let's compare to previous drops. We have the December one. It was 9% in 7 bars, so doable. Then we look at the September October one. It was 14.42% in 14 bars. Again, we can do that as well. We look at the previous drop. It was 7.9% in 8 bars. Still doable. If it would have went on for a bit more, it would have been doable. Then in May or in June, it was 12.51% in 6 bars. Before that, we had this drop, which was 10.49 in 5 bars. So it's easily doable if we get a big impulse drop down. But how can the difference between all these drops and the current situation is that they all started from a high, either from a high or from a rebound high. And like this, there was at least one or two green candles before it, so it was a rebound and rejection. And we're missing that now, so that's why I don't want to play short here. I think we actually recapture the midpoint and we start going up and we see 4,000. And when we get to 4,000, that's the real test. And if we measure from 4,000, from 4,000, we go back to, I will say the drop starts on March 8th, and I'll show why in a second. And wait, this one. So we start on March 8th and we go until March 30th, and we need a 12.68% drop. This is the super bearish case and it's doable, like we have 17 bars to do it. And the easy case, which is just an undercut of the midpoint, retest the January lows, maybe overshoot a bit and then bounce, is just 5.27%. This is easily doable. So let's look at the economic calendar. What do we have next Wednesday on the 8th? We have JOLTS. And then on Friday, on the 10th, we have non-farm payrolls and we have an unemployment rate. So what I think happens, and a couple of days later, like it's not here, but in the following week, we also have on the 14th. So we have on the 8th, we have JOLTS. On the 10th, we have um non-farm payrolls and unemployment. And on the 14th, we have CPI. So what I think happens is we get something like this or like this, and then the fun starts. So we go up until the 7th, because on the 8th is pre-market, so I think it's pre-market, I have to look again. And we should gap down again. We go down to 3900. It tries to bounce, maybe backtest this. Then non-farm payrolls comes on the 10th. I have to move this down lower. We get another impulse down. We go here, we try to bounce again, and then we get a hot CPI print, and the CPI print is hot. We do all of this. Like this will be consecutive 3%, 4% days, something like this. So this is like the bear porn scenario that I mentioned in a comment. And it's pretty much lining up. All we need is Jolts to be bad. If Jolt isn't bad and we get a good economic data, or good from a market's perspective, from a bullish perspective, so meaning bad, maybe we break out the 4,000 and we see for 10. Yeah, that's kind of it.